Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
China is in a very similar situation today, but actually in a little worse situation than the U.S. was in '29. The size of the Chinese consumer market relative on a relative basis is much smaller than the consumer market was for the U.S. in 1929, which means the export side, which is the production side, is much larger. They need to stimulate the Chinese consumer. But as I just showed you and made the point before, instead of using this massive stimulus to push into the domestic side, they're trying to rejuvenate trade, cutting trade taxes and everything else, giving all kinds of subsidies, trying to pump up the stock market to keep the politically connected princelings, so to speak, in the cities happy, the urban elite happy. But it's not creating the demand. It's not replacing the demand that's gone away. They can continue to push as hard as they can on the export side, but if the U.S. consumer and other consumers around the world aren't going to take their goods, they're not going to take their goods. So they're just creating a greater problem of massive overproduction, which means they're going to have more adjustment sooner or later, and we're afraid that's what's happening. And if they continue to push on the export side and don't take this adjustment domestically, you're going to see trade barriers go up in other countries against Chinese goods, and it could lead to a chain reaction of others. We already see trade barriers going up in India against a lot of Chinese goods. And it's a very bad situation because not only is China the last modicum of demand base still in the global economy, they're the key demand driver for the Asian countries. If you look at the exports from the Asian countries themselves into China, they were in massive that was their demand source, and growing in a very, very big way. They've fallen off the cliff. So whether or not China can turn the ball around here, I think is key to everything that goes on forward in the currency markets in terms of the dollar, and could be key. The other alternative scenario is that China muddles through here and the U.S. Muddles through, and they both grow and lead the world out of this global morass. That still may be beneficial for the U.S. dollar in that, from a relative standpoint, the U.S. could lead, and I'll get to that. So remember, watch China closely. What they do here in terms of trade and what they do in terms of here, whether stimulating their domestic side or their export side, is very critical to what goes forward in the global economy. Okay, if the export models are being crushed and demand does not return to the global economy, as our government officials are hoping it will through their massive stimulus campaigns, we think the BRIC countries, Brazil, Russia, India, and China, that have already gotten slammed very, very hard, even though they had these massive FX reserves that was supposed to carry them through, will get hit harder even again. We've seen major rebounds in these stock markets as optimism returns about China and optimism returns about emerging markets being very, very cheap. Emerging markets move directly in line with commodities. If you look, and I'll show you that in the next chart. Let me show you that now. Let me get to this chart. I'm sorry. Here it is. Point I want to make here, the black line here, and this is a weekly chart comparing the commodities index to the emerging stock markets. Commodities index is black, commodities are red. We do a lot of this intermarket analysis in our work to try and give us some indication of movements of the major asset classes relative to the major currencies. But as you can see, the emerging market stocks and commodities moving pretty much in lockstep. Commodities broke first, then the emerging stock markets broke. Makes sense. Commodities are the driver of growth for a lot and most of the emerging markets. It's a big part of it. So when they broke first, then all of a sudden the earnings started to get hit in the companies. Then the emerging stock markets broke. And of course, this also happens to coincide very nicely with the credit crunch as risk came into the world. When risk comes into the world, people run out of risky asset classes first. Emerging markets are the most risky asset classes as a rule. So that money came rushing back into the U.S. to hide in U.S. Treasuries. So you can see how tightly linked the commodities market is with the emerging stock indices. And that's why I say if commodities, come down again, meaning demand falls off the table out of China, these BRIC countries that everybody's excited about now will be in trouble. And the big bounce that we've seen in these emerging market currencies, and we've seen a very, very nice bounce over the last several weeks in these currencies as optimism has returned, we could see those fall off the table once again. So again, China's going to be the driver of this if these export models continue to evaporate. BRICS, Brazil, Russia, India, China. Submerging markets. Defaults. The IMF has been able to stave off a lot of these defaults that were potentially building in Ukraine, Argentina, Hungary, throw a dart in Central Europe. Poland's in pretty decent shape, actually, in a relative standpoint. Czech is next, but Hungary's still in very, very bad shape. And in that case, a lot of the major emerging market trouble from a potential default standpoint, because the money has just leaked out of these economies, is in Central Europe. And that goes to the heart of the euro, and I'll get to that potential. So we need some real global funding to come back in to really turn this around, and we've seen the optimism lately really help these markets. But that could change again in a very, very big way. We happen to think if China disappoints, you'll finally see a final capitulation out of the emerging markets. There's a lot of money that's gone back into the emerging markets the last couple months, and a lot of deep money has stayed in the emerging market economies from people still believing they were very, very cheap, and they've been rewarded here over the near term. But again, commodities will determine, we think, what goes on in emerging markets. And if commodities break, we think the potential for defaults increases, because we don't think the IMF has enough money to cover the potential problems out there. Slaughtered pigs, Portugal, Italy, Greece, Spain. I see somebody wrote up here Ireland. We could add Ireland to this list. But the pig countries, Portugal, Italy, Greece, Spain, perennial problems in terms of their fiscal side of their fence have always been a problem. They've piggybacked off Germany in the exchange rate mechanism, which is the euro. These countries have been able to borrow money at German interest rates, even though Germany is fiscally sound and disciplined. These countries were the opposite of that, but yet they were able for many, many years, because of this exchange rate mechanism, to borrow very near German interest rates on their sovereign debt. It's a false artificial system. What's happening now, people are starting to price a potential breakup in the exchange rate mechanism, which is the euro. And the reason you know this is because about 2 years ago, before this crisis developed, we probably had 20 to 30, maybe 40 basis points difference between Portugal and Germany in terms of their bonds. And now we have about 600 basis points difference in terms of risk being priced into some of these areas relative to German bonds. That tells you that the market is finally pricing risk into the exchange rate mechanism because of this. And as a gentleman just wrote up, Ireland up here and Iceland added to the list of countries that are already broken down, part of the Eurozone. You would have thought before this happened that Portugal, Italy, Greece, and Spain were in worse shape than Ireland and Iceland, and it just shows how fast things can change. So this risk being priced into the euro, we think is for real reasons, and it's fiscal problems and these Central European emerging markets.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.